Hello and welcome to the channel, your go-to source for understanding the complex world of short squeezes and hard-to-borrow stocks. Today, we're diving deep into a fascinating situation that's popped up on our screeners app. We're going to dissect what makes this microcap stock stand out and what these high cost-to-borrow fees really mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk app. This is a microcap company that recently triggered some significant flags on our hard-to-borrow screener. While a specific sector classification isn't readily available, its microcap status alone puts it in a unique category when it comes to market dynamics. Its estimated float is a tight 0.5 million shares, meaning there aren't a massive number of shares freely trading in the market. Now, what really caught our eye with ATPC, and frankly, what's often a precursor to interesting short squeeze mechanics, is its cost to borrow fee. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? When a short seller wants to bet against a stock, they first have to borrow shares from a broker. They then sell these borrowed shares, hoping to buy them back later at a lower price, return them to the lender, and pocket the difference. But borrowing isn't free. Short sellers pay a fee, typically expressed as an annualized percentage, for the privilege of holding those borrowed shares. This is the cost to borrow. Should chart simple graphic of CTB concept. Why does it matter? Because a high CTB means it's expensive to be short a stock. When this fee skyrockets, it signals increased demand to borrow shares, or a shrinking supply of shares available to lend out, or both. For short sellers, it eats into their potential profits, or worse, can accelerate their losses if the stock price moves against them. A CTB fee exceeding 100% annually, as we're seeing with ATPC, means that if a short seller held their position for a full year, their borrowing fees alone would be more than the value of the shares they borrowed. This puts immense pressure on short positions, pushing them to either cover or face astronomical holding costs. Why the stock is hard to borrow right now. ATPC has landed squarely on our radar because its cost to borrow fee is currently sitting at an astonishing 552.9% annualized. Highlight number, think about that for a second. That's not just high, it's extreme. Adding to this pressure, we've seen the CTB momentum for ATPC jump by a notable 28 percentage points over just the last 5 trading days. This indicates that the cost to short this stock is not only high, but it's actively getting more expensive, faster. Show screener snapshot. Furthermore, the supply of shares currently available to borrow is incredibly thin, at just 15,000 shares. When you combine that minuscule supply with a tight estimated float of only 0.5 million shares, you have a recipe for potential volatility. Our internal composite squeeze score for ATPC sits at a respectable 52.8 out of 100, which suggests underlying conditions are ripe for attention. However, it's crucial to note that despite these elevated borrowing costs, ATPC has seen 0% change today, 0% over the last 5 days, and 0% over the last 30 days. Volume has also been 0 shares today and averaged 0 shares over the last 30 days. This indicates that while the potential pressure on short sellers is immense due to CTB, there isn't any active price movement or trading volume right now to capitalize on. It's a classic watch and wait scenario where the fuse is lit, but the actual explosion hasn't happened yet. This could also mean that short sellers are still confident in their position, despite the fees. Squeeze mechanics explained. So, how does a short squeeze actually work, especially in a scenario like ATPC's? Imagine a short seller who borrowed shares of ATPC. They sold them, betting the price would drop. But now, their borrowing fees are incredibly high, at 552.9%, and the number of available shares to borrow is only 15,000. If something were to cause even a small uptick in ATPC's price, or if short sellers just decide the fees are too painful, they might choose to buy back shares to close their short positions. Show animation, short seller covering. When many short sellers rush to buy back shares simultaneously, it creates sudden, artificial buying pressure. This demand for shares, especially when the float is small like ATPC 0.5 million shares, can quickly overwhelm a limited supply. As the price climbs, more short sellers get nervous, leading to a cascade of buying that squeezes the price even higher, hence, a short squeeze. Dilution risk check. Before getting too excited about squeeze potential, it's vital to check for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This typically dilutes the value of existing shares and can completely offset or negate a short squeeze thesis, even if cost to borrow is sky high, because new shares provide an easy supply for short sellers to cover or for the market to absorb demand. For our checks found no recent dilutive SEC filings such as SMIN S1, SMIN S3, or 424B forms in the last 90 days. We also found no recent reverse splits in our look-back window, which can sometimes precede share issuance. This is a positive sign, as it means there aren't immediate, obvious factors that would flood the market with new shares and undermine a potential squeeze. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given APC's current state, extremely high cost to borrow are 552.9%, low borrower availability, and tight float, but critically, no recent price or volume movement. What should you watch for? The key here will be any catalysts that could ignite actual trading volume. Without volume, even with punishing CTB fees, a squeeze won't materialize. Look for a sudden uptick in trading volume, highlight volume BAR, even if it's small to start, especially accompanied by positive price action. This could signal that short sellers are beginning to cover, or that new buying interest is emerging. Monitor news specific to APC that could alter sentiment or attract attention. Also, keep an eye on cost to borrow. If it continues to climb or remains elevated while borrowable shares disappear, the pressure on short positions intensifies. Remember, high cost to borrow indicates short seller pain, but it does not guarantee a squeeze. It can also mean short sellers have strong conviction and are willing to pay those fees to remain short. At present, a fascinating case study in the world of hard-to-borrow stocks. With an eye-watering 552.9% cost to borrow and a very limited float of 0.5 million shares, the underlying mechanics are certainly in place for potential volatility. However, the current lack of price movement and volume means this is a situation to monitor closely rather than an active squeeze. Keep these metrics in mind as you conduct your own research. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analysis, and let us know in the comments below what other hard-to-borrow stocks you're watching. Thanks for tuning in, and we'll see you in the next one.